So let's have a look at part C, which is a little bit of theory. This year came up for your gearing. So this is 2020 past paper Fauci PLC ratios. So the question was, what are the disadvantages to a business of having high gearing? So the main disadvantages to a business is, number one, because there's high gearing, that means the company has a lot of loans out, which means you're going to be paying back a lot of interest on these loans. Interest is paid out of profits, but also dividends are paid out of profits as well. So if you've got high interest, repayments means less profits are available for investment elsewhere in the business. Shareholders are less likely to get a good dividend when gearing is high, because remember, your interest is being paid out of your profits. Dividends are also being paid out of your profits. The business would find it more difficult to raise additional loan finance. So if you've got a lot of loans out already, it means you're paying back a lot of interest. So banks will be reluctant to give you any more loans because of running the risk of you not being able to pay back the interest and not being able to repay back the loan. There's a higher risk of liquidation due to not being able to make interest repayments. So 4 disadvantages of having a highly geared company. High interest repayments means less profits are available for investment elsewhere in the business. Shareholders are less likely to get a good dividend when gearing is high. The business would find it more difficult to raise additional loan finance, and there is a higher risk of liquidation due to not being able to make interest payments. Part 2 then was explain 2 ways to reduce the gearing of a company. So remember, a highly geared company is when your debt finance is higher than your equity finance. So you might have to try to reduce your debt or try to increase your equity. So sell more ordinary shares to increase shareholders' equity as proportion of the capital employed. So you're trying to increase your equity capital there. Reduce or repay loans to reduce fixed interest debt as a proportion of capital employed. So you're trying to reduce your debt. Increase reserves or retain profits to increase shareholders' equity as a proportion of capital employed. So you might look at your profit and loss account, maybe reduce some expenses, maybe look at your gross profit, try to source your raw materials from a cheaper supplier, but not giving up on quality, and convert long-term debt to ordinary shares, reducing fixed interest debt and increasing shareholders' equity. So this long-term debt that you have, you might convert it into shares. So instead of repaying back interest, you're going to be repaying back a dividend instead. So you're reducing your debt, but increasing your equity. So 2 ways to reduce your gearing. So sell more ordinary shares to increase your shareholders' equity, reduce or repay loans to reduce the fixed interest debt, increase reserves or retain profits to increase share equity, and convert long-term debt into ordinary share capital, reducing the fixed interest debt and increasing your share equity. So that's part C, a handy way of picking up 10 marks.